Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm lucky enough to be joined by Brandon Fontaine. Brandon is a vice president and research associate on Strategas's fixed income and economics research teams. Brandon, how are you doing today?
I'm doing great, Ross. How about yourself?
Doing really well. Thanks for asking. We usually get to talk about a sector that's a little bit undercovered, I feel, when I talk to you, which is manufacturing. The way the economy has shifted, there's a little bit less of a focus on it, but it is no less important to talk about. It's still a big part of the economy. And so I want to get your recap of a couple recent manufacturing data points, both Strategas's proprietary work and the official ISM manufacturing PMI. So if you could give us a recap of what that data recently told us, and then we can, maybe focus on what's coming forward next.
Yeah, of course. So I'm just going to take a step back for 1 second and give a quick refresher on our SLIM survey. So our SLIM survey is our Strategas leading indicator of manufacturing survey, and that is designed to lead the ISM survey, which is the largest manufacturing survey in the country, by 2 weeks, specifically on the new orders and supply deliveries fronts. So our new orders index held in contraction at 58.4 in March. And while a lot of manufacturing surveys nationwide, the regional Fed surveys suggested that the US PMI would remain in contraction in March, the ISM PMI surprised to the upside with an expansionary reading, and that's the first expansionary reading in 16 months. We have not been in expansion, or at least the ISM survey has not been in expansion since 2022. And our survey from the onset of this year has done a very good job on the new orders front of really catching the turn in manufacturing, and we continue to expect a rebound in the sector through the rest of the year. Now, another note I'd say is on our supply deliveries index. That maintains about a 90% correlation with the ISM supply delivery index. That reading came in at 47.5, and that tells us that supply delivery times are continuing to quicken. Now, we've seen a lot of headlines recently about bottlenecks and Middle East conflicts leading to higher freight costs, but these higher freight costs in these headlines have yet to translate into bottlenecks that are affecting the manufacturing sector. So that's a very good sign for goods inflation, as rising bottlenecks could hamper or undo some of the progress that the Fed has made over the past 2 years.
Yeah, and there was a lot of concern about that, in December and January about whether that would have, a similar, if maybe a bit more muted effect to the COVID-19 lockdowns that similarly caused bottlenecks in the global supply chain sector. So, you mentioned that we're back in a, slightly in expansionary territory for the first time since 2022. I'm curious how these impact your outlook for the manufacturing sector over the next year or two. Obviously interest rates are still high. There's still inflationary pressures in parts of the economy. What does this tell you about the longer term outlook for the manufacturing sector, at least over the next few years?
Yeah, so that's a great question, and we continue to expect expansion in the manufacturing sector in the years to come. We have 5 main reasons for this. The first one is the implementation of previously passed industrial policy that is coming into effect this year and should continue to affect the sector in the years to come. The second is, as you mentioned, interest rates. Interest rates remain elevated, but despite the fact that we've gotten some stickier inflation readings thus far this year, the Fed looks intent on cutting rates potentially in June. That's our base case as of right now. And manufacturing tends to be a very rate-sensitive sector, so any sort of decrease in rates is going to provide a boost for the sector. A third reason why we are expecting a rebound is if you look at earnings per share estimates, whether that be for the S&P 500 or just the industrial sector earnings growth in those sectors, or at least analyst estimates of growth, suggest that the PMI should be in expansion and should be comfortably in expansion. So if earnings estimates are correct, the PMI should expand. On top of that, we have our conversations with participants, panelists, comments from the ISM survey. Those are continuing to suggest that the manufacturing sector is turning up to start the year, and demand for their products is increasing. And then lastly, if you look at the ISM survey, there are a couple components that we like to watch, or a couple data points from within the series that we like to watch, and that's the new orders to inventory spread. We like to see new orders outpace inventories by 6 to 8 percentage points as a sign of a healthy manufacturing environment. That is moving in the right direction. And then the number of industries reporting growth continues to expand off of its lows, and that is additionally suggesting to us that there is room for the sector to rebound. If this is a durable rebound in the manufacturing sector, then the runway for growth is really 1 to 2 years. Now, we've noted that head fakes can happen, but that being said, if this is a durable expansion, then there is a couple-year runway for growth in the sector.
Yeah, and that's great because, as we noted, the manufacturing sector not as big as the consumer sector in our economy today. But if the consumer were to take a bit of a breather after a great 2023, it would be really helpful if manufacturing and housing could kind of backfill some of that growth. So good to see, and we'll be checking in with you again later this year on your all's proprietary work to get an update on the potential for this expansion. But Brandon, I want to thank you so much for the time today. It's been really insightful.
Awesome. Thank you so much, Ross.
Thanks.